Hello everyone, welcome back to pifromus, the channel sharing knowledge about money and cryptocurrency. Do you believe that economics is an exact science where economists always have answers to every problem? If the answer is yes, then hold on tight, because this video is like a slap in the face, and it will shake the very foundations of the beliefs you've long held as unshakable truths. But if the answer is no, then congratulations, you've already seen a part of the true picture. A world where currency, inflation, and recession aren't natural phenomena, but rather cards shuffled by invisible hands. And sometimes, even those who seem to be in control become victims of the very game they created. Now, imagine you were a renowned economist in the 1970s, invited onto television to analyze the economic situation. You take a deep breath, sit up straight, smiling confidently, until someone poses a contradictory question. Professor, why does the economy have both high unemployment and high inflation? Your heart skips a beat, sweat starts forming on your forehead, because according to the economic theory of that time, the 1970s, this shouldn't be possible. Economists believed that when unemployment rose, inflation would fall, and conversely, when unemployment fell, inflation would rise. But it was happening right before their eyes. Why did they believe this? This belief stemmed from the Phillips Curve, a famous economic theory proposed by economist William Phillips in 1958. According to this model, when unemployment is low, meaning everyone has a job, and having a job means having money, then people will spend and shop freely without looking at prices. Initially, businesses eagerly ramp up production to meet demand, but then they realize that if customers keep buying like this, inventory clears out before goods can even be made, and raw materials and labor become increasingly expensive. So, businesses sit down, recalculate, and are forced to raise product prices. Furthermore, they realize that just covering costs isn't enough. They seize the opportunity to make more money from customers by pushing prices even higher. The result is soaring prices, leading to increased inflation. Conversely, when unemployment is high, people have less money, spending decreases, businesses cannot raise prices, causing inflation to fall. That was the theory of the late 1950s and early 1960s. A time when politicians looked at the Phillips curve, combined with John Maynard Keynes' interventionist theory, and laughed triumphantly, thinking, easy, just adjust interest rates, pump money, push unemployment down a bit, inflation goes up, then pull back when needed. The economy runs itself. However, that's just in the textbooks, the catchphrase of those politicians. What about reality? The nature of inflation isn't that it arises naturally or because the economy suddenly grows too fast, as some economics professors teach in introductory courses. What is the true nature of inflation? It's a game where one side consists of powerful figures, think someone like President Trump now, and the other side consists of asset holders, like the Fed's Jerome Powell, chairman of the Board of Governors of the Federal Reserve System, whom we often hear speak. These wealthy individuals will find ways to protect themselves, while ordinary people like us are pitifully crushed. Specifically, it can be described like this. Step 1. Sweet promises, and the government pumps money out initially when the economy is in recession and unemployment is high. Following John Maynard Keynes' theory, the government pumps money to save the economy, just like during the Great Depression from 1929 to 1939. Money floods the system, businesses recover, people get jobs, and spending increases. Everyone is happy, joyful, thanking the government, and the politicians beat their chests. See, we successfully saved the economy. Step 2. But the story doesn't end there. Then comes step 2. The billionaires and the rich are startled, yelling, "My assets are evaporating," meaning, too much money has been pumped out. Workers' wages increase, everyone is happy, but the tycoons are the most panicked. Why? Because they realize a harsh truth. Their assets, land, factories, goods are being bought up by this cheap money. The real value of their assets is being eroded because the currency is depreciating. Step 3. So, step 3 arrives. The billionaires, the capitalists, get together and tell the Fed, You've recklessly pumped money, devaluing our assets. Now, you better deal with it. But the Fed laughs loudly and says, hey, the economy is doing well. People have jobs. What do you want to intervene in? Step 4. And then comes step 4. At this point, the billionaires and tycoons look at each other and don't wait for the Fed anymore. They tell each other, we can't let the public use cheap money to buy up all our assets. Raise prices. And so, goods, real estate, and services simultaneously increase in price. That's the essence. The rich protect their assets by raising prices, while the public begins to suffer from escalating costs. Now is when inflation officially explodes. Step 5. Finally, step 5, a brutal cycle. Now, the Fed panics and hastily raises interest rates to bring inflation down. But it's too late. High interest rates mean businesses can't borrow capital and start going bankrupt, leading to high unemployment. The poor become poorer. As for the billionaires and tycoons, they remain rich because their assets are now firmly anchored at a high price level. And so, the inflation cycle ends. The rich have protected their assets, while the poor lose everything. So, what about so-called mainstream economics? What is the economic theory they teach you? Inflation is due to supply and demand. Inflation is because too much money is pumped. The government will regulate interest rates, and the economy will stabilize. These words sound logical, but they are only half the truth. And half a truth is no longer the truth. So, what is the truth? Inflation isn't simply about supply and demand imbalances or printing too much money. If that were true, Japan would have suffered terrible inflation continuously from 1990 until now, because Japan has been pumping money non-stop for decades. But in reality, Japan's inflation is low. Why? Because the money doesn't flow into the real economy, but gets trapped in the financial system. Meaning, Japan pumps money, but due to its aging population, people don't spend much more. The population is even declining. Businesses don't invest heavily, and banks can't lend much either. As a result, the money mainly stays within the financial system instead of flowing into the real economy. Therefore, inflation doesn't rise high like in other countries. They even experience deflation. In contrast to Japan, consider inflation in the US in 2022 during the COVID-19 pandemic. The US government pumped trillions of dollars into the economy through subsidies, unemployment support, interest rate cuts, and economic stimulus packages. People had more money to spend, especially when the economy reopened after the pandemic. However, this wasn't the sole reason for high inflation. At this time, large corporations took advantage of the situation to raise prices sharply as consumer demand increased post-pandemic. Many major corporations raised prices not just because of higher input costs, but far beyond what was necessary to maintain high profits. When everything like gasoline, food, and goods increased in price, consumers were forced to accept the new price levels. This gave businesses the opportunity to raise prices significantly without much opposition. The result? Inflation was caused not only by the money pumped out, but also by corporations manipulating prices, increasing the cost of goods to protect their profit margins. If inflation were solely due to the government's money supply, then when the Fed raised interest rates, inflation should have decreased rapidly, right? The core issue is that when money is pumped into the economy, working people have more money and start spending. But immediately, those who hold assets from real estate and commodities to stocks are startled because the real value of their assets is eroding. And to protect their assets, they immediately push prices up. Real estate prices rise, gasoline prices rise, commodity prices rise. Ultimately, inflation explodes, and the final losers are not the billionaires and the rich, because their assets have been anchored at a new high price level. Only the poor, those who own no assets, are crushed. What the heck is going on? So, back to the question from the 1970s. Why did the economy have both high unemployment and high inflation? Well, welcome to a new term in economics, stagflation, where stag comes from stagnation, economic recession, or slowdown, inflation comes from inflation. Stagflation is the phenomenon that made economists in the 1970s scratch their heads, tear their hair out, textbooks were flipped through frantically, economic models were challenged, and faith in market laws was severely shaken. Before the 1970s, economists believed the economy could only choose one of two paths: either accept high unemployment with low inflation, or choose low unemployment with high inflation. But then stagflation appeared, a slap in the face to traditional economic thinking, a difficult problem the whole world struggled to solve. Now, let's return to the 1970s, and I'll tell you the story of stagflation, when the economy was torn apart by politics and financiers. First, there were the calm years before the storm. In the 1950s and 1962, the Western economy, especially the US, was enjoying its golden age after World War II. The Bretton Woods system ensured the dollar was pegged to gold, creating global monetary stability. US allies recovered strongly thanks to reconstruction capital from the US, while American citizens enjoyed an unprecedentedly high standard of living. Everything seemed too good to be true. Jobs were plentiful, economic growth was stable, and confidence in the dollar was extremely strong. The whole world used it as a reserve currency. America had enough economic and military power to dominate the world order. But right in the middle of this extravagant party, the first signs of an economic nightmare began to appear. Entering the early 1970s, flawed political and financial decisions started revealing their consequences, pushing the US and Western economies into the vortex of stagflation, a situation never before seen in financial history, both high inflation and high unemployment. So, what caused this disaster? Three main factors combined to form a perfect storm. First, the 1973 oil shock, when the Middle East punished the West. In October 1973, the world witnessed a shocking geopolitical event. The Yom Kippur War broke out between Israel and a coalition of Arab states, including Egypt and Syria, aimed at regaining territories occupied by Israel during the 1967 Six-Day War. Meanwhile, the US and the West sided with Israel, providing strong military and diplomatic aid. In response to this move, OPEC, Organization of the Petroleum Exporting Countries, established in 1960, comprising major oil exporters like Saudi Arabia, Iran, Iraq, Kuwait, Venezuela, and other nations, mostly from the Middle East, decided to use oil as a political weapon to punish the West, especially the US, for its support of Israel. OPEC imposed an oil embargo on the US and many allied nations, simultaneously reducing oil production. As a result, oil prices quadrupled in just a few months, leading to terrible consequences. Production, transportation, and energy costs skyrocketed. Commodity prices also soared. Inflation exploded. Businesses couldn't handle the costs and began mass layoffs. Unemployment rose sharply, and people were stunned as the prices of gasoline, electricity, and food danced wildly day by day. Second, flawed monetary policy. With the US printing money like worthless paper, this had already laid the groundwork for the crisis. In the 1960s, the US spent massively on the Vietnam War. Following the French defeat at Dien Bien Phu in 1954, the US immediately intervened in South Vietnam with economic aid and military advisors. In 1965, the US officially sent troops to directly participate in the war in Vietnam, beginning a conflict that lasted until 1973. Fearing that without stronger intervention, South Vietnam would quickly collapse before communist forces, Washington believed that only military might could stop the Red Wave from spreading across Southeast Asia. The domino theory dominated their strategic thinking. If one country fell to communism, neighboring countries would also fall one by one like dominoes. Therefore, the US did not hesitate to plunge into the war, but they didn't expect to get caught in a quagmire with no way out. Besides printing money for massive spending on the Vietnam War, the US also allocated large budgets to social welfare programs, the Great Society under President Lyndon B. Johnson. To finance all of this, the US government printed money recklessly and pumped it heavily into the economy. Initially, Pumping money helped stimulate growth, but by the early 1970s, the market was flooded with money, while goods production didn't increase correspondingly. When the oil shock hit, the economy was like an overinflated balloon waiting to burst. The U.S. should have quickly raised interest rates to control inflation, but fearing it would worsen the economic downturn, the Federal Reserve Fed hesitated and failed to act promptly. Consequently, inflation continued to rise while economic growth remained stagnant. Third, the decisive blow came in 1971, when the dollar depreciated disastrously. After World War II, the victorious nations gathered to redraw the global financial order, and of course, the U.S., as the leader of the Allies, was undeniably in charge. The Bretton Woods system was finalized in 1944, and officially operational from 1945. With simple yet cunning rules, the U.S. dollar was king, and the whole world had to kneel and play by the rules set by the U.S. Washington declared unequivocally, 1 ounce of gold equals 35 US dollars. Anyone wanting gold needed dollars, but the catch was, only the U.S. had the right to print dollars. The rest of the world did not. So, what did other countries have to do to get dollars? They had to sell goods, resources, and labor to the U.S., or conduct international trade using US dollars. Of course, countries didn't necessarily have to hoard dollars, and could still print their own local currency freely. Nobody forbade it. But the problem was, if they printed recklessly without enough US dollar reserves to back its value, that currency would depreciate against the US dollar, leading to exploding inflation and economic crisis. So, while no one banned printing money, maintaining a stable domestic currency value and facilitating international trade still required hoarding dollars as backing. While other countries had to scramble to accumulate every US dollar to avoid economic collapse, the US sat back comfortably, possessing a huge gold reserve after we, and the unlimited, unchecked right to print dollars. Thus, from a national currency, the US dollar transformed into a special commodity, a form of soft power controlling the entire world. The global financial system at that time operated under the guise of a gold standard, but in reality, it was a US dollar standard, because only the US had the right to convert dollars into gold, while the rest of the world could only pray that the dollar maintained its value, otherwise, everything would collapse. Before the Bretton Woods system, the world operated under the classical gold standard, a financial mechanism officially starting in 1821, when Great Britain became the first nation to peg its currency to gold. Previously, gold had been a store of value for thousands of years, but it wasn't until the 19th century that nations made it the foundation of their monetary systems. After Britain, many countries like Germany, the US, and France gradually joined, creating a financial order where every currency could be directly converted to gold at a fixed rate. This system brought stability to global trade, but also came with a strict constraint. Nations could only print money corresponding to their gold reserves. However, the Great Depression of 1929 to 1939 not only plunged the world into a severe crisis, but also marked the end of the classical gold standard. When the US stock market crashed in 1929, numerous businesses went bankrupt, unemployment soared, and the global financial system nearly froze. In this context, governments realized that sticking to the gold standard, meaning only printing money based on gold reserves, would prevent economic recovery. Therefore, they were forced to abandon the system to freely print money, lower interest rates, and stimulate investment and consumption. This was a major turning point as the world officially shifted from letting the free market self-regulate, as per Adam Smith's invisible hand ideology, to an economic model with strong government intervention. It was in this context that the economic theories of John Maynard Keynes became prominent. Keynes argued that during crises, the market cannot self-correct and requires government intervention. Instead of letting the economy freefall, the government must proactively inject money into the economy through public spending, infrastructure investment, job creation, and promoting consumption. Conversely, when the economy overheats, the government should withdraw money by raising taxes and interest rates to control inflation. This is the pump priming economic theory. the foundation for fiscal and monetary policies in countries today. From this point, economic thinking changed completely. The world no longer believed in a monetary system bound by gold or an absolutely free market. Instead, governments and central banks became the drivers of the economy, regulating economic cycles through flexible fiscal and monetary policies. The later Bretton Woods system was also a form of such regulation. Gold still served as backing, but real power lay in the hands of the US, with the dollar playing the central role. But by 1971, as the whole world held dollars and considered them national reserve assets, people began to suspect, where did the US get enough gold reserves to print so much money? Consequently, countries started bringing their dollars en masse to exchange for gold. The US acted calm, but in reality, knew full well it didn't have enough gold to back the amount of money it had printed. The financial game the US had constructed was suddenly exposed. With no way back, US President Richard Nixon resorted to a dirty trick, like a child, by unilaterally abolishing the gold standard in 1971. This meant that from then on, the US dollar was no longer tied to gold, but became just a piece of paper printed with numbers, based purely on faith. Or to put it bluntly, believe it if you want, don't if you don't. What were the consequences? The US dollar was sharply devalued, its real value decreased. Countries lost faith in the dollar, leading to a global monetary crisis. The US had to import goods at higher costs, prices soared, inflation increased manifold. Businesses and investors panicked, hesitant to expand production. Unemployment rose. Combined with the oil shock and flawed monetary policy, the US and the West fell into an unprecedented dark period, a stagnant economy with extremely high inflation. And that was stagflation. So, facing this situation, what did economists in the 1970s do to pull the US out of the quagmire? And more importantly, the world in 2025 repeating that scenario? High interest rates, rising unemployment, faint signs of recession appearing. Are we perhaps entering a version of stagflation similar to the 1970s? Considering current macroeconomic developments and lessons from the past, will the Fed's monetary policy and the US government's fiscal policy be enough this time to help the economy achieve a soft landing? Or will they push us into another stagflationary recession? And this is where Pi Network reveals itself to the world. One could say Pi coin is a cryptocurrency with a time-based standard, fair, and potentially capable of protecting us from inflation. Everything will be analyzed clearly in the next video. Please like, share, and follow the channel to watch it. Thank you.